future tycoons. Starting a business is like joining a club, but nobody hands you a brochure explaining the rules. Instead, you're just bombarded with terms like sole proprietorship, LLC, S-Corporation, and pretty soon it starts to sound like an alphabet soup. Don't worry, I've got you covered. Today, we're doing a whirlwind tour of the most common business structures for small business owners. Stick around to the very end. I'll have a helpful bonus tip for you. So whether you're deciding on your first structure or thinking of switching things up, this breakdown will help you make an informed choice. And before we head out, make sure you hit the like, subscribe, and share buttons to make the algorithm do its thing. Let's start with the simplest structure, the sole proprietorship. This one is basically you and, well, you. It's straightforward. There's no legal distinction between you and your business, which means you keep all the profits, but also take on all the risks. The good news? There's minimal paperwork involved, and you can get started quickly. The bad news? If your business runs into trouble, your personal assets could be at risk because there's no legal separation between your business and yourself. Also, you'll need to pay self-employment taxes, which means you're responsible for both the employer and employee portions of Social Security and Medicare. And quarterly estimated taxes? Yep, those are now your new best frenemy. A partnership is like a duo. Think of it as you and a co-founder trying to build an empire together. There are two main types, a general partnership and a limited partnership. In a general partnership, both partners share responsibility for the business and for the debts. In limited partnerships, you can have a silent partner who invests money but isn't involved in the day-to-day operation of the business. Partnerships have more flexibility in terms of how profits are split, but there's a catch. You're both personally liable for the business. Also, like sole proprietorships, partnerships must pay self-employment taxes, and you'll still need to tackle those quarterly tax payments. Choose wisely. Your partner's decisions could affect your bottom line. The LLC, the Limited Liability Company, is a fan favorite for small business owners because it combines the simplicity of a sole proprietorship with the liability protection of a corporation. With an LLC, your personal assets, like your house or your Netflix account, are generally protected if the business runs into trouble. Taxes for an LLC are passed through, meaning the profits pass through down to you and you report them on your personal tax return. However, you still pay self-employment taxes on those profits unless you elect to be taxed as an S-Corporation. Which brings us to our next point. LLC taxed as an S-Corp sounds complicated, but it's essentially a way to save money on taxes. Here's how it works. You still get the liability protection of an LLC, but you pay yourself a, quote, reasonable salary and take the rest of the profits as distributions, which aren't subject to that self-employment tax. The upside? Lower self-employment taxes. The downside? You'll need to run payroll for yourself, file W-2s, and make sure you don't skimp on your salary, because the IRS isn't a fan of business owners paying themselves $10 a month while taking the rest as distributions. This structure works best for businesses with consistent revenue that can afford the extra paperwork. And remember, when you're the owner of an S-Corporation, you need to generally pay yourself 60% salary, 40% distribution. The IRS doesn't spell this out, but it's what they've accepted as common practice. The C-Corporation, the business structure of big dreams, big funding, and, let's be honest, big headaches. C-Corps are a separate legal entity, which means your business pays its own taxes, separate from your personal tax return. You'll also pay yourself a salary as an employee and can issue dividends to shareholders, including yourself. Here's the catch. Dividends are taxed as ordinary income on your personal return, which means you get hit with that infamous double taxation, once at the corporate level and again when you receive your dividend. On the plus side, C-Corps have more potential for growth, can raise funds from more investors, and can offer perks like stock options. But unless you're planning to go public or attract significant investors, an S-Corp or LLC might be a simpler choice. Now here's today's bonus tip. Whatever structure you choose, make sure to file the proper paperwork at the state and federal levels. It's not enough to call yourself an LLC or S-Corp. You need the documents to back it up. And keep detailed records. Your future self and your accountant will thank you for it when tax season rolls around. So there you have it, a grand tour of small business structures. Are you Team Sole Proprietor, Team LLC, or dreaming of going full C-Corp someday? Let me know in the comments. If this video helped you clarify your path, hit that like button and subscribe for more easy to understand business advice. Thanks for watching. And remember, choosing the right business structure is like picking a pair of shoes. It should fit comfortably, support your journey, and not make you trip in front of everyone. See you next time.